Our It's the Economy questions today. Will the cost of loans rise for corporates in India in FY24? Will our own home loan rates rise? That will depend on the budget and on, of course, global central banks. A preliminary CNBC TV18 poll shows that the government may go with a fiscal deficit of 5.8% for FY24 and it could budget a net market borrowing of 11.5 trillion rupees for itself. That compares with 11.1 trillion rupees that it is borrowing this year. Now add another 5.3 trillion thereabouts of states borrowing. Central and state governments could borrow a net 16.8 to 17 trillion in FY24. Okay, gross borrowing, of course, will be a good 5-6 trillion more. But on the other hand, US and global yields could tumble, like we saw in the United States overnight. So will India's rates move up because of budget and higher government borrowing and higher domestic borrowing, or will it move down as central banks stop hiking rates? I have with me Neeraj Gambhir of Axis Bank and Suyash Choudhary, the head of fixed income at IDFC AMC, both veterans in the bond market. Gentlemen, thank you very much for joining me. Neeraj, first up to you. Already we have seen that banks are borrowing, are giving higher interest rates both on CDs and on bulk deposits. And now it's quite possible that the government borrowing program is going to be a tad higher than what we saw in FY23. So are you preparing for higher yields?
So my base case, Lata, is that we will probably be somewhere close to where we are right now, which is at around 7.25% to 7.5% for the near term. Obviously, market is expecting that the government will actually show some amount of fiscal consolidation. So we're expecting, in line with what you said, a budget deficit of about 5.8% and the net borrowing program for both center and the states, which is not very different from what we did this year. So if those conditions are met, I think the market it's a kind of a status quo for the market. The bigger driver could potentially be the path of the monetary policy as we go forward into the next year. We are expecting a 25 basis point hike in February from RBI. And thereafter, I think the broad consensus is that we could be in for a pause for some time. No expectation of a rate cut as of now in FY24. So I think we are looking at a very range-bound government bond yield curve, for the next, I think, 6 to 8 months for now. Obviously, the markets are very volatile. There is a lot of moving parts here, particularly what happens to the developed market yield curves. But subject to those being along the expected lines, which the markets are currently expecting, I think there is not much of a change that we are expecting in terms of yield curve right now.
Okay. Well, Suyash, the government is borrowing. From preliminary estimates, central government is probably likely to borrow about 50,000 crore more than it did this year. This year, I think it is 11.1, and next year, the average I got from about 4 or 5 economists is 11.5 trillion. Now, this year, we had the advantage of a lot of insurance companies asking banks to give them forward rate agreements because there was a preference for higher yields. They had a product which sold. But now you have bank FDs also giving us, nearly 7.5%, if not more. So do you think that insurance company contribution may be less? Are you sure the market borrowing program can be as smooth as it was this year?
So, Lata, you're right. I think most market participants underestimated the depth of the local bond market last year. And like you observed, the borrowing program went through quite smoothly. In fact, yields for most part of the curve actually peaked in the month of May. And since then, market yields have actually been lower through the rest of the calendar year. You're right. Insurance has been a very large positive surprise over the last couple of years. We don't expect it to materially change in the year ahead. But even if there is some letting off of demand from there, remember there are compensatory sources that could potentially build up. Couple of compensatory sources could be at some juncture if the appetite for emerging market debt were to start to come back. If markets are right, for example, in the extent of monetary policy easing, they're already beginning to build for the Fed late this year and early next year. then that would be one compensation from a demand side. Second, some juncture late 2023 and purely for neutralizing the liquidity deficit, the core liquidity deficit that will arise by late 2023, the RBI may also begin to somewhat increase the size of their balance sheet via open market purchase of bonds, although this has probably been pushed back by 1 quarter because core liquidity is not shrinking at the pace we envisaged earlier, owing to balance of payment having stabilized. On CD rates, I would sense starting the April-June quarter as we pivot into lean season of credit, and as headline economic growth starts to slow down further, CD rates should also start to come off, although they may remain in the early 7 areas as opposed to the late 7s that they are currently holding. So because of all of these reasons, I would broadly agree with Neeraj. We are looking at more of income from fixed income finally after 1 year of heavy volatility. Obviously, if the Fed has different things in mind versus what the market is anticipating today, then you may have a bout of volatility slightly later in the year.
Okay. Now I'm going to ask some slightly rapid fire so that we can fit in more. Okay, Neeraj, would you, your thoughts only on this insurance companies' demand, will that be as good as last year and help a smooth moving of the borrowing program?
So there is a secular trend in the deepening of the financial markets, including insurance. I think that continues. Okay. If there is some cyclicity around insurance versus fixed deposits, then banks benefit. Basically, banks' balance sheets grow. So I think there is going to be some compensation one way or the other on the demand side.
Okay. Then now to come to the deposit part that Suyash alluded to obliquely. He said that after all, even banks are raising CD rates at 7.8 today. I think 1 year CD. Do you think that pressure may continue because deposit rates are lagging credit by a good margin? And as we were discussing yesterday with Srini, there could be a rush on the part of HDFC Bank also to borrow more as HDFC's liabilities, start maturing. So, I mean, is there pressure on the CD market? Can 7.8 become 8 first before it recedes?
So we have two parts to this story. One is what happens from now until the end of March. Okay. There's obviously going to be a bit of a pressure because all banks are seeing good credit demand and there is a need for liquidity. So I think CD market continues to see that effect. But in a slightly longer time frame, and I don't want to comment about an individual player strategy, but I think the key driver for us will be that how deposit growth sort of shapes up in the next fiscal year. Deposit growth usually is a lagging factor to credit growth and the liquidity in the system. So both of these things will actually drive where the deposit growth goes. If we see some reversal in the tepid growth that we've seen so far, you could see potentially less pressure on the CD market. But I agree with Suyash that these are probably elevated levels and may continue to stay so until the end of this fiscal. Okay.
Suyash, to come back to the global arena, after all, liquidity is going to be less. There is no taking away from the fact that the Reserve Bank wants, they've brought liquidity down from 8 trillion to what, 2.5 trillion today, and they want to get it into minus at some point. Likewise, the US Fed also is absorbing $1 trillion last year and will probably do that much in the current year also. If not that much, maybe something short of it, but liquidity will be less. So can the pressure on yields not abate even if the Fed stops hiking rates?
So Lata, as far as India is concerned, I think we have abandoned the experiment with negative system liquidity. I think from Dr. Rajan's era, we have rectified this, that system does not operate well in negative liquidity zones. So we continue to believe that as core liquidity starts shrinking towards, let's say, the 1.5 lakh area, from there, we will watch for RBI action more closely. Obviously, it has to be consistent with probably the direction of monetary policy, and we don't expect after February policy tightening to continue. You're right on, global liquidity, but remember there's an expectation loop in play today as well. And the market expectation loop today is that the Fed will be forced to cut sometime late this year, early next year, and therefore financial flows are currently responding to that. Like I mentioned before, the risk always is that the Fed's reaction is more asymmetrical. They are using the 1980s playbook. So they will probably not be wanting to give an inch even when inflation downshifts to the 3% area in the US. And at that juncture, you may have probably a minor bit of reckoning for markets. But I'm not so sure yet that that will firmly happen, because one hopes that the economic data rebalancing may not call for a major reckoning for markets at that point. In which case, the expectation loop will be the dominant loop, and probably at some juncture you will get a bit of emerging market debt flows as well.
Okay, Neeraj, I want to contest two things that Suyash is saying. One, are you convinced Reserve Bank won't go into deficit? I'm not so convinced. They seem, as well, inflation is not getting to 4. It is only getting from 6% plus to 5%, and maybe a few months even less than 5, but it is nowhere near 4. And core is at 6. The Reserve Bank statement says that. So do you think that the pressure remains higher on yields?
So I would also agree with you, never say never.
Okay.
My point is that there are, the key determinant of how aggressive the central banks are going to be from here onwards is, one, what happens to the growth. I think in India also, we are seeing some tapering up of growth, tapering down of growth for next year. Secondly, the shift from, let's say, 3-4% inflation in the Western world, and say about 5% inflation to 4% inflation in India, that last 1%, 2% is always very difficult to achieve. So the question that we have to ask is that how desperate central banks are to get that thing done in a very short period of time. Remember, we have seen one of the sharpest interest rate increase in the history in a very short span of time.
Yeah.
The full effect of this is yet to be seen. So I think the jury is still out. My base case is that Reserve Bank will actually want to wait and watch to see what happens to growth, what happens to the global, supply side factors before actually, coming down harder on inflation control. And I think we should continue to see a very balanced liquidity equation in the system over the next, I think, 6 to 9 months.
Okay. Just give me one number answer. How much will our home loan rates go up by this year, Neeraj?
The home loan rates broadly in the banking system are now linked to the repo rate. My base case for a repo rate hike is 25 basis points. So I think we should see that effect play through on the home loan pricing as well.
Okay. So here's one number. How much may corporate India, say a AAA company, pay more or less in FY23?
Within a 25 basis point range from where we are.
Well, that's not a great deal. So cost of money may go up by 25 basis at best. Suyash, Neeraj, out of time, thank you very much for a very rich conversation. We couldn't get in the fact that we could be included in the bond index, then everything changes. But that discussion for another day. We wrap up on Bazaar. Chartbusters up next.
Co-powered by Century Pro